I am hearing more and more people talk about a repeat of 2022. And if you're short-term memory and you don't remember 2022, there were a lot of stock investors who frankly got their heads cut off. Dan Niles actually went out over the weekend and said, hey, cash will be one of the things that this top pick for 2025. He sees raising dry powder so that you could take advantage of the deals coming as a great idea. I don't know Dan Niles, but I know Taylor from Life Goal Investments, who's a 12-year Wall Street veteran. So I simply want to ask you, Taylor, is it time to go to cash, or maybe it's too late already?
Yeah, it's an awesome question. This is something. So I run a wealth advisory firm too. So we run wealth management for a lot of underlying clients at this point, and the question's coming up, and the fear is starting to enter the market. I'll give some context around 2022 because it wasn't just stocks. It was everything. Almost everything. With one caveat, and I'm going to focus on that caveat in this conversation. So 2022, S&P draws down 18.11. NASDAQ, tech heavy market draws down 32.58.
Oh.
And so, yeah, you got torched, right? On both sides. And then, what was the large driver there? Confluence of events there, but largely it was inflation, right? So you had everything from coming out of COVID, PPP loans, stimulus checks, Russia's invasion of Ukraine was really a huge catalyst for inflation at that point. So inflation starts to rip. The Fed rips interest rates higher, smokes the stock market. And typically when you look at a portfolio that is a diversified strategy, most financial advisors only are building in stocks and bonds. So we just talked about the fact that your stocks got absolutely torched. And then you lean on bonds. You're like, oh, thank God I own bonds this year, because when stocks are selling off, yeah. So what eviscerates bonds is inflation. Inflation is worse on bonds than it is typically on stocks. And it was in 2022. So little context, the worst year ever for the index. The index for the S&P 500 of bonds is called the Bloomberg Barclays Aggregate. The worst year ever, and I mean ever, was 1994. The bond index was down 2.94%, so less than 3%. Mm-hmm. In 2022, it was down 13.02. Yeah, brutal.
Oh, let's take the worst ever by 5, please. We'd like some of that. And by the way, stock's down too. So yeah, not a good year.
So if you own a combination of stocks and bonds, like, congrats, you're diversified with two massive black eyes, right? So that begs the question then, like, is cash a piece of the portfolio? And I for our clients, the answer to that is no. I will say that the number one thing we've done throughout the entirety of our careers, I say ours, mine and my business partners, is get people out of cash. Now, what cash is a riskless asset. A riskless asset will always underperform over time. Are there periods where it will outperform? Absolutely. And if you can time it right, God bless you. But you know this old Wall Street adage, the Market Timing Hall of Fame?
Yeah.
Empty room.
Empty
right?
room.
So instead, what you have to do is you have to, okay, if we're going to take our risk buffer, which is what people view cash as, off the table, you better damn well know how to construct a portfolio that can handle all parts of the economic cycle. And so everything from growth, economic expansion, to inflation, to stagflation, to a recession. And so if you think about stocks fit squarely in they do well when the economy is growing. They do well with modest inflation. They do not do well in stagflation or in weak growth. And when inflation really kicks up, they really struggle. So you complement stocks with bonds because bonds typically hold up well in stagflation and in recessions. But that leaves that inflationary period just null and void. There's nothing that does well when inflation really kicks up. And that's probably Dan Niles' point, as cash holds up well with inflation. Granted, you get burnt by inflation because your purchasing power gets disseminated. But at the same time, at least your asset price is not getting crushed. That is where the massive array of misunderstanding in the asset management business or the financial advisory business has a blind spot. And that blind spot is on the alternative space. So alternatives are your anchor to wayward with inflation. And what are they? You know one of them very, very well. Real estate is an amazing alternative asset. So you can either give the synopsis on why it does so well in inflation, or I can. Why don't you do that? You tell people why inflation, real estate is a great inflationary hedge, because I'm
Well,
rambling.
this is why I think Life Goal Investments is unique, and this is why I'm so happy you come back each and every week, because I think a lot of the noise in the media is, I think it's called the 60-40 split or whatever that is. It's either stocks or bonds or both, and there are environments over time where that doesn't work. 2022 being one where you got your head cut off on both sides. It's like, what can I do? And you've always talked about, going back to our very early discussion years ago, a Life Goal Investments is unique because there is always that third tranche. And it's not only one rental at a time, residential financing, fixed rate debt, inflation is a feature, not a bug, is something I've been saying for years, which helps hard assets, especially when the debt is fixed. But also there's things on top of that I know you're a part of that aren't one rental at a time, like farmland, right? And these other assets. So again, I think you just need to keep going, right? Rental properties, people know inflation's a feature, not a bug, but there's so much there. Timber, right? All of these other, assets that are real estate, right, fall under that umbrella. But these aren't things that guys like me, mom and pop investors are going to play with. That's why you're a wealth advisor. That's why Life Goal Investments is unique, because you have a focus on these third areas. So keep going.
Yeah, thanks for saying that. Let's just peel apart some of what you just mentioned there. So let's rewind back to 2022 and look at some of the cause of inflation, and we'll see cause and effect on different asset classes. So farmland, perfect example you just gave. So one of the big kind of powder keg moments for inflation was when Russia invaded Ukraine. Yep. So when Russia invades the Ukraine, Russia
breadbasket is the
breadbasket. Yeah. Exactly right. So Russia, as a tactical play, well, let me give this context. Ukraine is the fourth largest exporter in the world of wheat and grain. That is their economy. So when Russia is trying to tactically strangle them, what they do is they cut off access to the Black Sea. Yep. And therefore they can't get their crop to market. So when you think about a commodity like farmland just being supply demand driven, or any crops being supply demand driven, if Russia strangles a lot of the outgoing crop out of Ukraine, all of a sudden that commodity gets constrained, low supply. If the demand is still intact, what you have is other farmland then appreciating in value just due to scarcity. And if you think about, this is a crazy chart. If I was quick enough, I'd show it on the screen right now. I'm not. But if you look at population growth globally, and you look at it at 60 years, I guess I'm backwards. It literally, you cannot see a blip on it. Population has basically doubled globally over the past 60 years, and every single year, like absolute clockwork. And if you think about a supply demand scheme, and you think about demand for farmland being people eating food, and that demand consistently increasing every single year, and then you think about the supply side of it, what you have is, as populations grow, cities get bigger, they get pushed out into suburbs, and they get pushed out into what was farmland. So now you have high demand with diminishing supply. And you wonder why farmland has created returns like clockwork. Like the consistency of farmland has been unrivaled by any asset class. The consistency of returns. In a 2008 scenario, 2008 S&P draws down peak to trough 49%. Farmland for that year is up 15.84%.
Wow.
It's awesome. Yeah. All right, let's think about another commodity, oil. Russia invades the Ukraine. Russia is the third largest producer of oil on planet Earth.
Wow.
Third largest planet, and so what happens there is every Western nation says, screw you, Russia, we're not buying your oil. Sucks the supply out of the business, and all of a sudden oil prices go to the moon. That was part of the cause to inflation. So if you have an oil investment in 2022, it's helping you keep your head above water. So I think the biggest thing that your average financial advisor does not understand is interest rate sensitivity.
Yeah.
Interest rates are the baseline to every single asset on the planet. And the problem is, as interest rates go higher for stocks, all of a sudden their operating costs go up because financing costs go up. Mm-hmm. Bonds, traditional bonds, as interest rates go higher, what you have is, if you're sitting in a 10-year treasury yielding 4%, and new issued 10-year treasuries come out at 5%, you go, screw that 4%, I'm going to go out and buy the 5%. What happens to the price of that? It comes down. Yep. But there are also bonds that are floating rate in nature.
Mm.
And those are natural offsets to the other side of the coin, which are traditional fixed rate bonds. So infrastructure debt. We talk a lot about this on our social media channel. Infrastructure is a white hot need in the market right now. Why? Because AI uses an unfathomable amount of energy.
Yeah.
And I'll give you context. Right now, Meta is building a facility, a data center in Louisiana. They're putting 3 power plants around the outside of it that could power more than 1 million US homes to power that data center.
Oh,
That's
wow.
the incredible demand. And so if you have all of this balled up demand, pent up demand, our entire economy right now is thriving based on what AI is going to do in the future. AI is not going to do shit if we can't build out enough energy. But the
Right.
great thing about energy contracts and these power plants, infrastructure, et cetera, is they're based on floating rate. So you have a credit spread on top, and then you have underlying federal funds rate, or SOFR, which SOFR directly is impacted by federal funds rate. So in the event like 2022 that interest rates go up, it just benefits the underlying yield getting kicked out of this product.
It's something I've never looked in. So let's educate the audience. Again, I talk all the time about 30-year mortgage being, average 30-year historical average of 185 basis points, the 10-year to the 30-year. What's kind of a spread, a normal spread between SOFR and these? I mean, are we talking 300, 400, 500 basis points?
Here's the interesting part. This is crazy. So right now, you're getting about 500 basis points of spread on
Wow.
top of SOFR. So these products are yielding like 10% right now. And you look at that and you go, okay, that much yield, red flag, red flag, red flag, intrinsic risk.
Right.
And then you look at the long-term 40-year statistic of what default rates are on infrastructure debt, 1.2%.
Wow.
And so what's happening, the reason that there's such nice risk-adjusted return on offer in the market right now is that largely these are called PPIP relationships. So contracts are PPIP, public-private partnership. So the government comes in, they structure the contract, they bring 50% of the capital to the table, and they look for outside investors to bring the other 50%. Well, what the government realizes is that the golden goose that's paying all the tax receipts right now are technology companies and all of their underlying employees. And if we can't allow AI to proliferate, that goes away. And so what they're doing is they're structuring really incentivizing contracts in order to attract capital to come in and build out the energy that our country so desperately needs, because it's not just AI, it's also electric vehicles. It's also the third big player, which sounds crazy, but it is a massive draw on the energy infrastructure of our country, is crypto mining.
Mm-hmm.
Those are 3 new entrants into the game that never existed before, and we have not built out enough energy in order to encapsulate what's needed there. So I'm kind of all over the place right now, but bring it back to like the original part of the conversation is trying to time your way into and out of the market has made a lot more people poor than it has rich. At the end of the day, it's a dual fold decision. It's when do you go to cash? And then it's, okay, even if you get it right, when do you come back in? And typically the time to come back in is when it's really, really scary. Yeah. And so it's not try to bust in and bust out of the market. It's create an all-weather tire that can manage all 4 parts of the economic cycle, from growth to inflation to stagflation to weak growth or recession.
Yeah. This is what makes life goal investments pretty unique, in my opinion, because again, you're not only the kind of the classic 60-40, been tried and true for 40-year nonsense. You realize there's this third angle, which offers protection. And again, you balance the portfolios and tweak the knobs. I'll let people kind of figure that out if they want to reach out to you. But one of the things that I do see about cash, and I've done this only a couple of times, and again, I'm over rotated on real estate. Let's be clear.
Yep.
Stock's not my thing. Crypto, not my thing. I have a little bit of each, but it's not where it's not where I spend 2 hours a day.
Yep.
Right. I see cash, if you are an elite investor at something, as being kind of like an opportunity cost.
Totally.
Right. So something I've been very clear on my channel for the last year or so is I have been stacking cash because I see a tidal wave of pain coming to the commercial real estate market, right? I know for a fact that roughly 50% of the bridge debt issued in 21 and 22 and 23 are going to require at a minimum a cash in refi. And I expect most people not willing to do that, which means at some point, this bullshit extend and pretend nonsense, which is occurring right now, the check will become due. I don't know when that is. My current guess is late 25 or 26. So again, for a guy who's over rotated on a single asset class, I got to agree with, with Dan. I'm going to cash like never before, or rarely before, because I'm going to make a play. And to your point, if I'm wrong, I pay off some debt, whatever in 26, 27. So that's kind of how I look at this.
My only counterpunch to that is, and I don't know your unique scenario, but what we would be looking to do if we were your financial advisor is say, instead of stacking cash and your cash yielding 4% and after tax yielding 2.5%, whatever the number is, what we're going to try to do is find an asset class that has 0 to negative correlation with what it is that you're fearing or what it is you're trying to offset, which is real estate or whatever it might be. And therefore, if you do get that commercial real estate collapse that you anticipate, this asset will actually have appreciated in price. And it will be
that's why you're so good.
Well, we haven't done it, but no. But the point of it is, more importantly, is that while you wait, this is also going to be a risk asset.
Right.
It's this working risk for asset should outperform cash. And again, your pieces of the portfolio, if you have everything in the green or everything in the red on days that are not extreme, and I know this is not real estate because it doesn't book that way, but I'm just saying your investment portfolio has everything in the green or everything in the red on a boring day, you have a terrible portfolio because you have no offsets, right? So you're all directionally moving in one direction. Now, extreme days, exogenous days, everything can be in the green or everything can be in the red. Don't get me wrong. But on your average day, you need to have some stuff going up and some stuff going down. And you can have a directional bias, don't get me wrong. But if you don't, and the market moves against you in a direction that you don't think it's going to go, you're going to get eviscerated. And that's not what you want. You want to be able to have long-term compounding returns.
Well, this is something that you and I should probably talk about privately. We will definitely set that up. I'll let you know kind of the ins and outs and the dollar amounts of everything I got, so we can have that more deeper conversation. But at the end of the day, cash is an asset. It is a choice, but there are, to your point, other ways that it can be deployed. And timing the market. I love that joke about Wall Street, that timing the market Hall of Fame is a blank room. I hadn't heard that before. So pretty cool. Taylor, where can people find you?
Yeah, find us at Life Goal Investments. We're on both Instagram and on TikTok. And then the link that you see right there, if you want to set up a conversation with us and talk about what it is that we do, use that link right there.
Awesome. Thank you so much.
Thank you.